Keith Sprauer, Chief Investment Officer at Global Wealth Advisors, and this is the third quarter of 2024 outlook. The first half of the year is in the books, and with everything that's gone on so far this year, we have had what I feel is a very strong performance, at least for the first half in the equity market. And I know there have been certain stocks driving this performance, but it's still a very solid first half. I heard a stat recently that said that every major investment firm's year-end targets on the S&P 500 have been achieved by the end of June. That tells you where strategists thought we would be this year and where we actually are. You can see here from the performance chart that year-to-date on the far right, which includes the second quarter, U.S. large cap, emerging markets, and developed international are all doing reasonably well. The underperformance so far is in fixed income and small cap, which should perform well as the Federal Reserve gets closer to making cuts to the Fed funds rate. So I believe that as we move through the third quarter, we'll continue to see positive performance, and I'll get into why shortly. As a reminder, the Federal Reserve has hiked rates 11 times since March of 22, but has taken no action in their last 7 meetings. This is a familiar graph in my quarterly talks, and the reason for that is that markets work on expectations. If those expectations are met, whether it's an earnings report, a Fed movement, economic data, and so on, you'll get a certain market reaction versus if the data comes in away from those expectations. I think that it's good that the Fed and the market are close on what's expected going forward, as you can see from the far right side of this graph. We know from past history that when the market and the Fed are very divergent, we see significant volatility. We have seen some softening of the economic data, and that has given investors a comfort level that the Federal Reserve will begin a rate-cutting cycle. There's been a lot of discussion around how the markets will perform once that begins. The market is looking forward to them, but we've seen historically that rate cuts aren't automatically good for stocks. And what the market is saying, at least at the time of this taping, is that there's about an 80% chance that the Fed will cut the Fed funds rate by 0.25% or 25 basis points at their September meeting, as you can see here in the graph. This kind of certainty, for lack of a better term, is because we've seen some softening in the economic data. In particular, data that's important to the Fed's decision. So what we're looking at here on the left is a moderation in GDP, just under 1.5% growth in Q2, and by using the Atlanta Fed's GDP forecasting, they see Q3 as slightly lower than that. Now, I will say that these estimates can bounce around quite a bit before the final number is released. Just over the past week, I've seen the third quarter estimate anywhere between this 1.2 and 2%. On the right is CPI, which continues to bump along, but it is without a doubt decelerating. So it's increasing or positive, but at a slower rate. I split the softening data charts into 2 slides so it might be a bit easier to see. And what we're looking at on the left here is the unemployment rate. And we can see that for June, it moved above 4%. That's a level that needs to be noted because it's something that the Fed was looking for before rate cuts could be considered. And lastly, on the right is the Institute for Supply Management Services Purchasing Managers Index. Recall, this is a diffusion index, so above the level of 50 is showing growth and below is showing contraction. The drop you see here since the last report was a surprise to the market. The manufacturing side has been under 50 for quite a while, but the services side has held up. It's not a shock really, given how long we've been in restrictive monetary policy. Hikes affect the economy with a lag, just as cuts affect the economy with a lag. But the markets are forward-looking, and as mentioned, it's a question of expectations and how things will play out. Is there a reason to be concerned about a recession or what would be considered a hard landing? I don't think so. We may have moved back to a soft landing case from what's considered a no landing, meaning no slowing at all. But a lot of this data I'm referring to is only getting us back to where we were pre-pandemic. If you look at the mindset of investors, they are still feeling bullish on equities. You can see from the chart here by Investors Intelligence that bullish sentiment in the market is still high and remains high. As we saw with sentiment, how people are feeling about the markets can depend on many things. A few of the things that are important to look at are both earnings and valuations. If valuations or prices get too high without earnings growth, you can have problems. But as you can see from these two graphs, valuations gauged by the price to earnings ratio is high on a forward basis over 21. But when you look at the median, it's closer to 18, which I would consider a reasonable number. Importantly, on the right, when you look at all of the S&P 500 companies, about 83% of them have positive forward earnings expectations. I've been focusing a lot here on U.S. equity markets because I feel that with some of these metrics in place, combined with some Fed movement to lower rates, we could see what may be considered a melt-up in the equity markets over the next quarter. I think this is an interesting set of graphs about technicals or maybe dynamics of the market, where we've seen a lot less issuance via IPOs or initial public offerings versus companies just staying private. So the supply side of equities is marginal, as you can see on the right, and buybacks, which is taking equities out of the market, remains robust. So there's a certain amount of support in the market given these imbalances. I keep coming back to money market assets as part of the puzzle to the forward movement of all markets. This is data as we started the third quarter with short-term rates elevated compared to recent history. The compounding of the amount of cash in money market funds is bordering on exponential. You can see that between retail and institutions, there's over $6 trillion in money market funds. If we do see a post-Fed rate cut rally, investors may take profits and put that money in cash, but I think it's just as likely that investors would want to move some cash into risk assets to participate in the rally. And I can see a portion of that money moving into not just equities, but the fixed income markets to capture price appreciation as rates go lower. What does this mean for the intermediate term outlook? As we've discussed in the past, when we look at markets, we put probabilities on outcomes. Looking forward out over the next few quarters, these would be some of the possibilities and my percentage probabilities around these outcomes. I'm focusing here on two factors: growth, which includes a lot of economic data within it, and inflation, because it's been a driving factor over the last couple of years. So my base case, and I'm saying 60% here, is that growth stays steady, meaning a trend of 2% or so, and that inflation continues to decelerate. In this case, both stocks and bonds should have positive performance. The Fed wouldn't need to cut aggressively, earnings would stay positive, and the labor market stays historically strong. Another possibility that I would say has a 30% chance of happening is growth slowing and inflation slowing, which could move us into a recession, where fixed income would perform well due to the Fed cutting to try to spark the economy, and asset allocation shifts out of risk assets into fixed income, but equities would suffer. And then the lowest probability listed here is at 10%, and that's if growth is slowing and inflation is increasing, causing stagflation, which would be difficult for traditional asset classes across the board. This is the lowest probability because historically when we've seen this, productivity has been very weak, and it's currently not weak, and we don't expect it to become weak. Which brings us to headwinds and tailwinds. When we look at the headwinds, I see sustained restrictive Fed policy starting to affect the economy, as we discussed earlier. The upcoming elections are beginning to get interesting, and we did see the Treasury market react to the recent presidential debate. Immediately after, longer interest rates spiked up due to the thinking that there may be a Republican sweep, which could mean more spending, as we've seen in the past when one party is in power. It would also mean increasing Treasury issuance to pay for that spending, and possibly an increase in inflation due to a stimulated economy. We spoke about cash and the comfort level some people have in it. And we recently saw a big jump in the deficit spending, going from a deficit of $1.5 trillion to $1.9 trillion on a year-over-year basis, Q1 to Q2, according to the Congressional Budget Office, the CBO. And that's a $400 billion increase in deficit in 3 months. This will likely go on until a crisis gets the government to act and become more austere. On the tailwind side, there continues to be in place corporate and personal balance sheets being very strong. Earnings continue to be strong as well looking forward. And there's certainly a strong indication that the Fed will begin to cut rates, which should help support the economy and bring down borrowing costs, which will likely be seen as a positive for markets as well. Thanks so much for listening. If you want to see more content from Global Wealth Advisors, please consider subscribing and following our social media channels, and I'll speak with you next quarter.